I love that answer because it's the first thing that people do. Just human nature is to start hiding or stick their head in the sand and pretend like it's going to fix itself, and it's not. I mean, 99% of the time it's not. And the 1% is pure luck. Welcome to the Generations of Wealth podcast. I'm your host, Derek Dombeck. Today, I think you're going to kind of see a little theme here lately. We've been having more and more guests that are on about raising money and syndications, multifamily properties. And Joe is another one, but I love his take on how he's done it and how he grew into it. So before we bring Joe on, I'd like to take a moment, like every week, to thank you for being here. Number one, anything that we can do to help you, don't hesitate to ask. We appreciate you if you spread the message of the Generations of Wealth show and share this wherever you can. And of course, give us all the likes and the loves on social media. But for that, consider us part of your network and your family. And go to derekdombeck.com if you want to schedule a call with me to talk about a deal or talk about raising money, or if you want to invest in a deal, anything like that. So with that, I really appreciate you being here, and let's bring on our guest. And here he is, the myth, the legend, the man, Joe Rinderknecht. How are you doing today, sir?
I'm great. Thanks, Derek. Excited to be here.
Well, I appreciate you being on the Generations of Wealth show. We were jamming a little bit before we hit record on this episode, and got a few things in common and a few places in common that we both enjoy. But why don't you tell the audience a little bit about yourself?
Yeah, I'll just give the quick Cliff Notes version. So, yep. Name is Joe Rinderknecht. I am based in Southeast Idaho. Pretty much grew up in both northern Utah and Idaho pretty much all my life, bouncing back and forth. Grew up on my grandpa's cattle ranch in northern Utah. Um, and as you know, we'll talk about, but like I'm a multifamily operator, syndicator, and a lot of the values and ethics, that I have now for my company are, I learned on the ranch, working hard, your word is your bond, like when you shake somebody's hand, that's your word and your word is your bond, right? It's like what I'm teaching my kids right now. It's like when you shake somebody's hand, that's your word, learned all these valuable lessons, hard work, ethics, and just being honest and all that you do working on the ranch. So grew up doing ranching, and then my dad was a general contractor, and where I was the oldest of all of my siblings, I was the one who got the most, in. I got a lot of experience working construction and going through high school. Would spend, many nights after school, like helping my dad trim out spec houses. And so in which, I never knew then, but like the construction experience that I got is significantly impactful to multifamily and, construction now, because I've manually done everything from laying a foundation to drying in a house to trimming it out. Right. So, got lots of good experience there. And then, I was pretty much a blue collar worker, if you will, all the way up until 2018. So ranching, construction, actually drove semi for 3 years from 2015 to 2018 while I was going to college, um, and had a small family. And then well, I guess let me rewind just a little bit. I started in multifamily in 2016, bought a duplex that we house hacked. And so for 2016 to 2018, I did small multifamily, um, to kind of learn the business, right? And then after I got out of driving semi in 18, I decided I wanted to go all in on large multifamily and decided to figure out people who are doing what I wanted to do and go work for them. So I spent 3 years without buying a property from 18 to 21, working for a property management company, managing an 80 unit LIHTC tech deal, working for a group out of Austin, group out of Vegas, and a group out of northern Utah. just learning all of the ins and outs of doing multifamily, from cold calling sellers to underwriting, just all the way to dispositions, right? Um, and then kind of fast forward now, I bought my first big deal in 21, and now we're in 26. And just in the last 2 years, my partner and I have acquired 419 units across 4 deals across 3 states. Um, and I have a fund of funds as well. So I have a couple passive investments in Ohio and Texas. But most of what we're doing now is we're buying deals in Montana, Idaho, Utah. We don't have a ton of competition. It's like most of the Utah, Idaho people are investing in, Ohio or Georgia or Texas. So, my partner Levi and I, we've been doing multifamily for about a decade now, right, in our backyard of Montana, Idaho, Utah. And so we've built a really good reputation, and um, have lots of results now, gone full cycle on deals. So kind of a quick jumbled
Yeah.
intro.
No, I love it. And the thing I picked up on, which is very similar to my background in growing up, blue collar, construction, dairy farming when I was a teenager, going milking cows before school and milking cows after school for a neighbor. That type of work ethic, you can't really you can't learn out of a book, number one.
Right.
But a lot of people listening to this might say, well, I don't have that background. Does that mean I'm not going to be as good or can't do what you guys do? And that's not true. It's
Right.
just it's just that when we go and hire a contractor and we've had the experience of doing it ourselves, we know if we're getting snowballed or not, or if they're trying to take advantage, right?
Right.
But on the other side, and I'd love your opinion on this, I don't have the tech background that a lot of people have. I was outside getting my hands dirty. I wasn't sitting inside on a computer. So we all have our strong points and our weak points. How does that play
Right.
into your business?
Like with the tech, or
Well, just
just strengths
overall.
and weaknesses?
Yeah.
Yeah. I'm completely with you. Tech is not something I'm very good at, and like learning a lot of the AI stuff, but I think you just find people who can complement,
Mhm.
the strengths. So like we just hired a kid who interned with us for a year. He was going to school at BYU, Idaho, and he's far more tech savvy than myself or my other partner, and so like he's building a whole bunch of stuff for us right now, so we can continue to focus on what we're good at, which is, raising capital and asset management. So I think if you don't have the skills, like you either go find somebody. It really depends on like where you're at in your journey. But you go find somebody who can complement those skills, or you go do what I did, is you go work for somebody who already is doing it, and you pretty much give them your time for free while you add value to them and learn that skill.
And that's a very important point because when you want somebody's mentorship or somebody's knowledge, it's got to be give and take. And
Yeah.
if somebody is just giving you their time and their knowledge and you keep taking and taking and taking, it's not going to last very long, and it shouldn't last very long, and you shouldn't want to do that. But I have people throughout my career of 2.5 decades that came in, they were green, they didn't know anything about real estate, but again, they had other skill sets, and I was happy to have them on the team, whether they were interns or paid employees or whatever it was. So
Yep.
love that. So okay, so when you went into your first duplex, was that a calculated decision knowing, hey, I'm going to be a real estate investor and I'm going to build up to what you have now or 400 units? Or was that just kind of, we're going to dip our toe in and see what this is like?
Yeah. Kind of two ways. Like I always knew that I was entrepreneurial. Um, living up on the farm and ranch, like we had, bought and sold cows, right? Um, And so I knew I wanted to do something in business, and but we ended up getting into it more because of need than anything. So in 2018, 2015, my wife and I, we were going back to school at Utah State University in northern Utah, and we had just come to Utah from working on a ranch in Wyoming, and like school had started, there wasn't any jobs. We couldn't find any housing. Like it was crazy. That was like when there was literally no supply. And so we ended up living with her parents in their basement and working for her parents. They run a trucking company. So I went and got they put me in CDL school and she was a bookkeeper for them. So we stayed there for about a year, saved up money, and then we ended up getting pregnant. It just was tough, trying to keep good relationships with your in-laws while you sleep right below them and they're also your boss. It's just tough,
Yep.
right? So we're like, hey, we need to get out of here, especially after we got pregnant with our first kid. And we started looking, and we had saved up some money and some good W-2 income, and so we started looking for, like, I was in the business school and I had a couple of mentors that did multifamily, and they said, hey, you could go get an FHA mortgage and this would be the best way for you to get into it. And so we actually ended up buying, it's crazy to say it now, but like we bought the most expensive duplex on the market, which was 176,000 in 2016. It's
Hmm.
crazy to think about now, right? Now, same duplex is probably, I don't know, 300 to 400 grand at this point. But anyways, we house hacked it. We went and got an FHA mortgage, lived in the basement that was like 400 square feet, rented out the upstairs, and pretty much lived rent free,
Hmm.
right? Which was amazing. And just being in the middle of that got me addicted to multifamily, or at that time single family. And so we had added a lot of value to our house by increasing rent, doing some improvements. We ended up getting like a $30,000 HELOC and use that money to go buy like an SREO fourplex.
Okay.
Not yeah, what is it, real estate? Oh, anyway, a deal that was going into foreclosure that the bank
Hmm.
was trying to take over.
Yep.
So, and then that kind of just snowballed from there and doing small multifamily to big multifamily.
All right. So then fast forward to the last couple of years, you've been able to do something that you did allude to. You don't have a lot of competition, but we've had people on this show that they have not been able to find an actual deal in multifamily since 2021,
Right.
just because cap rates and cost of everything.
Yep.
How did you source those deals, and how did those pencil out?
Yep. So, I mean, all of our deals are, so of the four deals that Levi and I bought, so we bought our first one September 30th, 2024. Um, we bought that deal in 54 units, 98 built in Missoula, Montana. That's a deal, like that's a market that we had been tracking for a couple of years, right? We tried buying a 101 unit back in, I believe it was 22. And that deal was sold for 300,000 a unit. So it's like, I feel like the way that we have been able to get deals done is because like we know our markets very,
Mhm.
very well. And like Levi, I mean, this is a testament to good partnerships, but like Levi, it's crazy how much like he remembers. Like we'll talk to a broker today about a deal that sold back in 23, and he'll know exactly what deal it is in our main markets, right? So when this 54 unit popped up on LoopNet, it was going for like 120 a unit, 98 builds. There are 6 and 8 plex. We're like, holy cow, like that's a crazy deal, right? And we ended up bidding against, I guess, 12 other offers. Um, and to, I guess, make a long story short, we increased our price like 3 times, 50K non-refundable day one. And if you remember back in end of 24, like that was kind of a
Mhm.
hairy time with interest rates. And most people I don't think would do this deal because it was like a 3.8 going in cap rate, right? But we knew the market and we knew where we could get rents. So like the average rents then were like 785. with majority two beds. Today, the rents are like in the low 1500
Okay.
range, right? So I think the thing that we had was like we knew our markets really well, and my partner Levi, he had built broker relationships. Like I had done a really good job at investor relationships for the last 10 years,
Mhm.
and he's done very good at building broker relationships, right? So a couple of
Well, enough people have been inquiring, and I'm going to make this super simple on all of you that are listening to the show. If you have any desire to work with me, whether that is a transaction that you're working on that you need help structuring, if you'd like to buy a deal that I have for sale, if you would like to sell me something, whether it's real estate or a business, happy to talk with you. Or if you want to be a financial partner in one of our real estate transactions, simply go to derekdombeck.com. On the homepage, there will be a tab and there will be a web form for you to fill out. Check the boxes that make the most sense for what you want to do, and you will get directed to schedule a call with me and let's have a conversation. Let's see what we can do to work together. So look forward to hearing from you no matter what it is that I can help you with. Again, go to derekdombeck.com, fill out the web form, schedule a call, and I will talk to you soon.
these deals that we bought were more or less pocket listings from brokers, and brokers were trying to get deals done too. And so they're like, hey, who's the buyer who can, most realistically get this done without retrading or,
Yeah.
um, you know, so I mean, that's largely how we were able to do it. And three of the four deals were owners that had owned it for 10 to 20 plus years. Right. So that's kind of who we target is kind of yourself, do it yourself landlords. And um, like the big deal in Texas we bought was a debt distress deal. We're working on a couple in Montana and Idaho right now. They're debt distress deals that like we never thought we could see debt distress in Montana and Idaho, but it's happening, because they did buy in 21, 22, when interest rates were 3 and 4%,
Yeah. So how did
so they have to sell now.
yeah. So you fund the name of your company is Cowboy Capital, and I want
Yep.
to touch on that too, as far as how you raise funds. But funding these deals, especially that first one in September of 24, did you already have the investors lined up that you needed, or what did the funding look like for that first one?
Yeah, so that no, we did not have the funding lined up on that one. Um, so when we were buying that deal, we at that time, I think that's when like debt and like hard money was like really prevalent. And I think that's also when like the stock market was like spitting off like 8 to 10 plus returns.
Mhm.
Excuse me. And so when we went and tried to raise common equity, it was extremely difficult, right? Because like people are like, cool, you're going to give me very little cash flow and, I'll get, upside in 3 to 5 years, right? But, we had to look at our competition. And so what we ended up doing was we ended up raising 2.05 million as pref equity
Mhm.
with a weighted average 15% return. So we had a couple investors come in, one at 800, one at 700 grand, couple 250s, and then a whole bunch at 25K. Right. So we knew that we couldn't compete doing common equity. So we raised everything as pref equity. And then my partner and I both um, we both sold the property. So we actually brought in $650,000 of our own money in common equity,
Mhm.
and investors really like that too because we're in the first loss position if something were to happen. So our 650 in common equity would get wiped out first, right? But the flip side to that now is our investors wish that they had common equity because we bought that deal for 6.8 million and we have it on the market right now for 11.5,
Yeah.
right? So they're just going to get a return of equity and they're 12 to 15% pref, but Levi and I are going to get all the upside. But it was what we needed to do at that time. We had to, I feel like on every single deal we've bought, we've had to pivot, in
Mhm.
our capital raising structure with, you know, fully like a full pref equity to quasi pref and common to like the most recent deal was just all common equity, so we've had to pivot quite a bit to raise capital.
Well, and a lot of people have had a tough time raising capital the last few years. And
Yep.
part of that is because the deals just aren't deals. But part of that is how you raise capital. And we were talking before we started recording about Cowboy Capital a little bit. Um, you kind of cater your company to your target investor market, right?
Right. Yep. Yep. So we target largely um, uh, ranchers, farmers. We have quite a few of them, and blue collar millionaires, guys that are in the trades. And I would say too, it's like we got our first family office check um, on our third deal that we bought last year. We're just over a year of ownership, and it's an old rancher from North Dakota.
Hmm.
So it's kind of cool because I think lots of people think that family offices are largely institutionalized, but we've actually raised quite a few funds from what I would call just kind of your self-proclaimed family offices, right? You got one guy that's raising from mom and dad and brothers, sister, bringing it all in one LLC. Um, so we've had a lot of success with that. Um, but I think a lot of our investors, like, there's been so much like on like social media, people showing all the glitter and the glamour and how awesome and just lifestyle. Where with us, like we're very much more trying to be real and raw.
Hmm.
And we'll post on social media when we get punched in the face. Like one of our most recent posts was, we passed on a deal back in April that we were under contract for 6 months on, and we lost earnest money and 6 months of time, and you know
Hmm.
so it's just like we'd like to be real and raw, and that's a lot of like what our investors like to see right now is, and we're just extremely honest with where we're at, and we have nothing to hide, so we'd rather show failures with the successes,
Yeah.
because then
And
people know that we'll always be honest in our dealings, right?
and that's the reality of raising money is the people are looking at the deal, but they're looking at the operator, and as they should, because a good
Yep.
operator is going to put their investors first, no matter what, and they're gonna jump on the grenade or take the kick in the head when it has to happen, if it has to happen. And I know in the past, I co-owned a hard money lending company, and a lot of our investors uh, were with us for years and years and years. And a lot of our borrowers were with us for years and years and years. And we had some borrowers that they had deals that went bad, but they treated us right. I mean, we were protected,
Yeah.
and we could have taken away the properties and been made whole, but we did workouts with investor or not investors, borrowers. Um, Talked to our investors and said, this is what's going on with this property. And some of those borrowers, we lent to them again because of how they handled themselves on the personal level and how they handled the challenges. Um, and that's why I know early on you said, your word is your bond, and when you shake somebody's hand, that's what it is. And that's the way I was born and raised. And I would love if everybody we dealt with was the same way. But the reality
Yeah.
is, you give somebody your word, you back it up with paperwork, and then you back it up with action and do
Yep.
what you say you were going to do, right?
Yep.
So what's a couple other challenges that you've either had or that you see coming in the future with your market where you are?
Yeah. I think challenges, I mean, supply is always kind of a challenge right now, right? Texas is getting, I feel like they're finally getting to an absorption period where things are getting a little bit better, but Texas has been hit really hard with supply. Like we own a 292 unit in San Marcos, Texas, which is there between Austin and San Antonio, and our occupancy has struggled. Affordability has struggled. And so, we're expecting, right, supply to catch up and or absorption to catch up to supply. But I think like when we're evaluating a deal, um, you have to what I wish I'd have done early on, because I had a deal that went bad in 21 that I can speak briefly about as well, is I wish we would have like raised additional funds, right? And we did on our Texas deal. We have plenty of funds to last us another year or two if supply doesn't get, fully absorbed. I think that's where people get in trouble is when, if they do a variable rate bridge loan, they don't raise enough to buy another rate cap in a couple years, or, they don't plan for negative cash flow. Um, so all of those are, indicators that we're looking at and raising extra capital for. Like, it brings investor return down, right? But I would rather be conservative in my raise and my numbers, and because if it catches up really quickly and we can start distributing and do a refinance, then that's great. I'd rather how does the saying go?
Under promise and over deliver.
Thank you. It just slipped my mind. Yeah, under promise, over deliver. And so looking at, I would say going forward is we've got to really under promise, over deliver, because it seems like everybody I'm talking to, especially like bigger family offices, are a little gun shy right now because they think interest rates are going to keep going up, and supply is going up. We don't really have to worry about supply much in Montana and like Idaho, just because supply fell off the cliff and they've been trying to absorb. Like Boise is our other main market, and there's like nothing, very very little on the docket right now to be built. So we're capitalizing on those opportunities in Missoula and Boise right now. um, but I think once it comes up again, we're going to have to keep an eye. I think this all goes back to say, like, when you do your underwriting, like, just be so conservative and raising extra working capital for like debt reserves. If you're going to do distributions, raise a little extra for distribution, because you don't know how long it's going to actually take. It's funny because my business partner always says, he's like, the pro forma and the underwriting is great, but usually the second you close on the deal, you can just throw it out the window, because all it is projections, right? Like,
Yeah,
you just got to do your very best to make predictions and projections based on where it is today, because you don't know what's going to happen in the future. You have to make your very best decision on where it is today, so
yeah,
those
absolutely,
are all indicators.
for sure. Well, Joe, what's one question I should have asked you that I did not? And it can be about anything.
I think one thing is, like, how should sponsors, I guess, communicate with their investors? um, I have a fund of funds that invest with us, and they've raised multiple millions for our deals. But what's wild to me is that, like, one group that they work with, um, like, they don't do any like monthly or quarterly, um, like, distributions or reporting, for that matter, right? And so what we have built in Cowboy Capital is like full transparency. If you're an investor with us, even if you have, say, 25K or 2.5 million, right? Our biggest check we have raised is 2.5 million on our last Texas deal. It doesn't matter. Like, I want that investor to, like, if you text me and say, "Hey, can I see the bank statements?" Or, "Cool, I'll send them to you," or, "Hey, where are we at with property management?" Or, "Can I go walk on the property and talk with management?" Of course, you know. So it's just crazy to me how many operators are out there are not giving their investors like that level of transparency and openness. Because it tells me, like, if you're not willing to show me your bank balances, like, I know I'm a small fish in your investor equity, but like, tells me that you might be hiding something,
Mhm.
right? And I'd rather just give you all of that from the very beginning, because then it just shows that, like, we have zero to hide. We are transparent. And our motto is like, we run out bad news, walk out good news, right? Because at the end of the day, when it comes to raising money, like that's how we have been able to raise money quite easily,
Mhm.
is because when things got hard and a deal went sideways back in 21, I had a conversation with our biggest investor, and I didn't know if he was going to um, like sue us for, I guess, like negligence, right? For not communicating what was actually happening. Like we were on the brink of foreclosure with this deal,
Mhm.
and so like was transparent with him where we were at, and we ended up having to do a capital call and had to do distributions, or we had to pause distributions and do a capital call. But because I did that, that investor has invested multiple millions with me and has referred multiple millions with us and is now on our board of director. He's one of our board of directors for Cowboy Capital. It's because we had that level of transparency and openness with him that, he's that's how you build relationships, right? They're long term, they're open, and
Mhm.
we communicate, we have fierce conversations when we need to.
I love that answer because it's the first thing that people do. Just human nature is to start hiding or stick their head in the sand and pretend like it's going to fix itself, and it's not. I mean, 99% of the time it's not. And the 1% is pure luck if it does. So,
Yep.
well, Joe, I really appreciate you giving me some time for the show and just sharing your story with us.
Yeah, I'm happy to be here and glad glad to add some value if there were some good nuggets in there, and appreciate what you bring to all your listeners, Derek. I'm sure your show is a huge value to them.
Well, I hope so. So, for those of you listeners, I hope it is a true value to you, and we bring people on like Joe to bring you the knowledge and the experience, and not just the good, but the hurdles and pitfalls as well. So, go out and share this show and help us spread the message of the generations of wealth. And until the next episode, go and live your vision and love your life. See ya.